Top Forex trading terms. Every beginner must know. AZ glossary. Have you ever watched a Forex trading video and heard words like pip, spread, leverage, margin, stop loss, or lot size and wondered what they actually mean? If so, you're not alone. Every successful Forex trader was once a beginner who had to learn the language of the Forex market before placing their first trade. In this video, I'll explain the most important Forex trading terms every beginner should know using simple language and practical examples. By the end of this video, you'll understand the basic vocabulary used by traders around the world and feel much more confident when reading Forex articles, watching tutorials, or using trading platforms. Let's get started. Think of Forex trading like learning a new language. Before you can speak a new language fluently, you first need to understand its vocabulary. The same is true in Forex trading. Learning the meaning of common trading terms makes it much easier to understand charts, educational videos, market analysis, and trading strategies. Let's begin with one of the most important terms: a currency pair. Forex trading always involves two currencies. For example, EUR/USD. The first currency is called the base currency. The second currency is called the quote currency. If you buy the EUR/USD currency pair, you are buying euros while selling US dollars. Understanding currency pairs is the foundation of every Forex trade. Next, let's talk about the ask price and the bid price. The ask price is the price you pay when buying a currency pair. The bid price is the price you receive when selling a currency pair. The small difference between these two prices is called the spread. The spread represents one of the main ways Forex brokers earn money. Whenever you open a trade, understanding the bid and ask prices helps you know exactly where your trade begins. Another important Forex term is the pip. A pip is the smallest standard movement in the price of most currency pairs. Traders use pips to measure profits, losses, and price movement. Even though one pip may seem very small, hundreds of pips can make a significant difference in your trading results. Now let's talk about leverage. Leverage allows traders to control larger trading positions using a smaller amount of money. For example, a trader with a relatively small account may be able to control a much larger position through leverage. While leverage can increase potential profits, it can also increase potential losses. That is why beginners should always use leverage carefully and never risk more than they can afford to lose. Another important concept is margin. Margin is the amount of money required by your broker to open and maintain a leveraged trade. Think of margin as a security deposit that allows you to access larger positions in the Forex market. Understanding margin helps you avoid problems such as margin calls and unnecessary account losses. Professional traders also pay close attention to risk management. Two important tools are the stop loss and the take profit. A stop loss automatically closes a trade if the market moves against you by a predetermined amount. A take profit automatically closes a trade once your profit target has been reached. These tools help traders control risk, protect their trading capital, and remove emotional decision-making from the trading process. Now let's look at support and resistance. Support is a price level where buyers usually become active, preventing prices from falling further. Resistance is a price level where sellers often become active, preventing prices from moving higher. Many traders use these levels to identify possible buying and selling opportunities. Sometimes price breaks through support or resistance with strong momentum. This is known as a breakout. A breakout often signals the beginning of a new trend. However, experienced traders usually wait for confirmation before entering the trade, because not every breakout is genuine. You may also hear traders talk about bull markets and bear markets. A bull market is a market where prices are generally moving higher. A bear market is a market where prices are generally moving lower. Recognizing whether the market is bullish or bearish helps traders decide whether to look for buying opportunities or selling opportunities. Another important term is price action. Price action simply means analyzing the movement of price itself instead of relying on many technical indicators. Many professional traders prefer price action because it allows them to read what buyers and sellers are doing directly from the chart. You'll also hear the term volatility. Volatility refers to how much prices move over a certain period. High volatility usually means larger price movements and greater trading opportunities, but it also means higher risk. Economic news, interest rate decisions, and major financial events often increase market volatility. One more important concept is risk management. Risk management is the process of protecting your trading account by controlling how much money you risk on every trade. Successful traders understand that protecting their capital is more important than trying to win every single trade. Without proper risk management, even a good trading strategy can fail. The good news is that you do not need to memorize hundreds of Forex terms overnight. Start by learning a few important terms every day. Practice using them while trading on a demo account. As you continue learning, these words will become familiar, and understanding Forex trading will become much easier. Remember, every professional Forex trader once started exactly where you are today. Learning the language of Forex is one of the most important steps toward becoming a confident and disciplined trader. If you found this video helpful, don't forget to like this video, subscribe to the channel, and turn on notifications so you never miss our beginner-friendly Forex tutorials. For the complete A to Z Forex trading glossary and more free educational guides, visit buildsmartafri.com. Thanks for watching, and I'll see you in the next video.